We're going to continue our discussion on transfer pricing by looking at a situation whereby you can be given a target. Your target will be the basis of you coming up with your transfer price, that's your residual income target, bit of you coming up with your target price, with your transfer price. So we've gathered knowledge on what residual income is. So who can tell us what residual income is? Residual income. Anybody to help on what residual income is? Residual income. Yes. Anybody? Residual income. When we talk about residual income, what are we referring to? Yes. Let's make it snappy. Working by on the network to knock me out. Anything I'll be doing it very fast. So residual income, anybody speak to that?
You know,
Yes.
it's a performance measure used to assess profitability of a division.
Okay. So how is it determined?
It will be determined by controllable profit minus notional interest on capital.
All right. So thank you for that. So residual income is a financial performance measure that shows how much profit a business earns after charging the after charging for the cost of capital it uses. Because the notional interest is the interest given the cost of capital on your capital employed. On your capital employed. So it is your controllable profits, operating profit or divisional profits, less your notional interest or imputed interest. And your imputed interest is computed as cost of capital multiplied by capital employed. Now, when we talk about residual income, in a question, you can be asked to determine transfer price based on residual income. When you are asked to do that, you must do what we call walk back for you to determine your residual income. For you to determine your residual income. So we've established that residual income is divisional profits less notional interest or imputed interest. And for you to get imputed interest, as you can see on the slide, it is your cost of capital multiplied by your divisional capital employed. So now, it is very clear that revenue is a function of quantity and selling price. Revenue is a function of quantity and selling price. So for you to get your residual income, it will be your revenue less various costs. What are those costs? Your variable costs, less your fixed costs, and also less your imputed interest on capital employed. Then you get your residual income. So for us to get our transfer price, when residual income target is involved, there's always a need for us to follow a format. And if your residual income is equal to revenue minus variable cost minus fixed cost minus imputed interest on cost on capital, what will be your revenue? you can make your revenue the subject of the formula, as you've seen on the screen here. Your revenue will be equal to what? That is from this point. For you to get residual income, we say your revenue less variable cost, less fixed cost, less inputted interest cost on capital employed, you have residual income. Now, on the other way around, to get your revenue now, it means everything here, your variable costs will cross to the other side, your inputted, your fixed costs will cross to the other side, your inputted interest cost on capital will cross to the other side. So in doing that, your revenue will be what? Your residual income plus what? Your variable costs plus your fixed costs plus your inputted interest. So when you add all these, that will give your revenue. So we're going to show this in a tabular form, in a tabular approach, so that the question we forwarded yesterday that we didn't solve, we'll quickly solve it using that approach. But before we solve it using that approach, let's see how the format looks like. Let's see how the format looks like. So let's present the format. Please write in your book because you're going to use this format to solve a question. So format for residual income. Format for residual income. Format for residual income. So once you start with a question and you see residual income target, you quickly bring forth this format because the various variables will be in the question. You will see it. Yes, it should not be hidden. So the first thing we have in our format will be it can be budgets. It can be budgets, stroke targets, because we're trying to get revenue. We want to get revenue now. It can be budget, stroke target, residual income. Budget, stroke target, residual income. You have a value for it. Then when you get your budget, stroke residual income, for you to get your divisional profit, what will you do? Your divisional profit will be the addition of your notional interest. That is, you need to add your notional interest. How do you get your notional interest or imputed interest? It is the cost of capital given in the question multiplied by the capital employed. Notional interest. So once you add, you should have a value, and that value will be termed as what? As your divisional profit. As your divisional profit.
Excuse me, sir. You say cost of capital is capital. You said notional interest is cost of capital multiplied by capital employed is divided by.
This is it. Imputed interest or notional interest is cost of capital multiplied by divisional capital employed.
Okay, sir.
So once you do that, you've solved questions on that before, ma. We've solved questions on that. For you to get your notional interest or imputed interest, we've given a question related to that before. That's the cost of capital given in the question multiplied by your divisional capital employed. Then you get your imputed interest or your notional interest. So once you add your notional interest plus your target residual income, you're going to have your divisional profits. And now your profit plus your fixed cost will give you what? Profit plus fixed cost will give you what?
Contribution.
Fine, to give contribution. All this approach we should be used to this now. Yes, profit plus contribution and plus fixed cost will give contribution. Will give contribution. Now, contribution plus variable cost will give you what? Contribution plus variable cost will give you what?
To give sales.
Very good. To give sales.
Sales.
Yes. Yes. So in a bigger platform, we'll say revenue, right? Mhm. Yes. we'll say, because on a normal day, when you're trying to get your contribution, we'll say selling price minus variable cost, isn't it? So once you work the other way around, you get what? You get so so contribution plus variable cost will give you revenue. When it is in units, it will be selling price. Selling price. So you have it as this. You have it as this. Then in this revenue, this is the overall revenue. The overall revenue of a division. Now, a division can have external customers. Aside selling to the internal division, there can be external sales in this revenue. For you to determine the transfer price for a division within your organization, you must remove the elements of what? Of the external sales, external revenue from this overall revenue. It is the internal revenue that is left. You now divide the quantity that you want to give out to your division, to the division within your organization. You divide that revenue by the quantity to determine the target transfer price, the required transfer price that will make the organization to meet up with its target residual income. So that is why this format is coming. The target residual income is given. You add your notional interest, you get your divisional profit. Your divisional profit plus your fixed cost, you have your contribution. Then contribution plus variable cost will determine, will give you your revenue. Will give you your revenue. So you're trying to determine the transfer price that you transfer goods to your internal, to the internal division in which you operate together. So in this revenue is a comprehensive revenue consisting of your sales to external customers and your sales to your internal division. So the revenue, you need to determine the portion of the external revenue from it. Once you determine that portion, let's determine that, let's say, external revenue. External revenue. Now, once you determine your external revenue, you less external revenue from the overall revenue. What you have will be what? The internal revenue. That is the revenue you get when you sell to the internal division. To the internal division, you have your internal revenue. Please, in your book, you can put less external. Less. So once you less, you have the revenue for the internal division. This overall revenue, for you to know the selling price, the transfer price for one unit, what quantity are you give? Is a format that we have to follow to be able to solve any question that involve target residual income. Target residual income. As I've said, that once we solve this question, I forwarded. There's another question involving two divisions again. I think it's in May 2024, something like that. So I'll search for it immediately after this so that you can attempt. And I think I have another question on opportunity cost. So the question will be solving this evening. involve quite a number of issues. We'll be looking at instance of opportunity cost. When you have to transfer based on opportunity cost, what are you to do? When you have to transfer based on target residual income, and when tax is involved, what are you to do? So we'll look at that question now. I believe everybody have the question so that somebody can read. So this is the question. Can somebody read, please? This is the question. Yes, can we read? Anybody? Can we read, please? Hello, can you hear me? Can anybody hear me, please?
Yes, sir.
Yes, sir, we can hear you, sir.
Yes, sir.
Yes, somebody should read,
Yeah.
please. Yeah, somebody should read.
Okay.
Read this question, yes. You can read out.
Niger Group Limited has been in operation since 1980, playing a leading role in the automobile industry. Division X, which is part of the group, manufacture only 265 by 16 rim tire, which it sells to extend customers and also to Division Y. Another members of the group, Niger Group policy is that one, division have the freedom to set transfer price and choose their suppliers. Two, it uses residual income for the performance appraisal. Three, the group cost of capital is 12% per annum. The two divisions operating data are as follows. Division X, budgeted information for the coming year is maximum capacity, external sales, external selling price, all are figures. So let me. Division Y. Division Y has found two other companies willing to supply tires. Hardest Limited could supply at 28,000 naira per tire, but only for annual orders in excess of 50,000 tires. Banners Banazar Limited could supply at 33,000 per tire for any quality ordered required. A. If Division Y provisionally requests a quotation for 60,000 naira tire from Division X for the coming year. 1. Determine the transfer price per tire that Division X should quote in order to meet its residual income target. 2. Calculate the two prices that Division X would have to quote to Division Y if it becomes the group's policy to quote transfer prices based on opportunity cost. B. Evaluate the impact of the group's current and proposed policy on the profit of Division X and Y and on the group profit. C. Assume that Division X and Y are based in different countries and subsequently pay taxes or different rates. Division X at 55%, and division Y at 25%. If division X has now quoted a transfer price of 30,000 naira per tire for 60,000 tires, you are required to determine whether it is better for the group if division Y purchases 60,000 tires from division X or from address limit.
All right, thank you very much for that. So, looking at this question, let's analyze, please. Looking at this question, we have two division, division X and division Y. Now, division X is producing tires, and they have external sales. They have people who request for tires to the tune of 110,000 tires. External sales. Take note, please. External sales, 110,000 tires. Now, if they are to sell to division Y, what quantity is available for them to give to division Y? Yes, can I get a response? What quantity? If they are to sell to division Y, what quantity?
40,000.
40,000. Yes, take note. Yesterday I gave a format. I don't know if anybody put down the format. I said, when you're giving a question, look out for certain things. One, what is the maximum capacity? What is the external sales? The difference between the capacity and the external sales will give you the excess. The excess is what you have to give to your internal division. Is what you have to give to your internal division. Now, in this case, the maximum is 150. The external sales is 110,000 tires. So if division Y want to buy from division X, they can only get 40,000 tires based on certain consideration. Now, that 40,000 tires, division X can sell to division Y based on opportunity cost, because if they don't sell it to division Y, they are likely to lose the whole money. So they can sell to division Y based on opportunity cost, just to cover up for their cost at the cost of production, not at the selling price. We're going to come to that point. Let's just take note of some things. So the external selling price is 35,000 naira per tire. Now, the variable cost of producing one tire is what? 22,000 per tire. Fixed cost is 1,080,000. Capital employed is 3,200,000. Targeted residual income is 180 million. 180 million. Take note, once you see all these variables, all these things playing out, you should know that you have to use your residual income format to solve, to determine your transfer price that will meet your residual income target. So division Y has found two other companies willing to supply tires to them. One is Ades Limited, could supply at 28,000 per tires, but only for annual orders in excess of 50,000 tires. And Banasa Limited could supply 33,000 naira per tire for any quantity ordered. Now, the first requirement, that if division Y provisionally requests a quotation for 60,000 tires from division X for the coming year, one, determine the transfer price per tire. Take note, see the statement. Determine the transfer price per tire that division X should quote in order to meet its residual income target. Revenue is a function of what? Quantity and what? And price. Revenue is a function of quantity and price. So that is why we're using the format we presented. We work backward to get the overall revenue of the organization. Then we now determine the external revenue. Then from the internal revenue, we'll be able to know which approach should we adopt based on the selling price. Now, everybody have the question, right? So we'll follow this format. to determine the answer to the question 1, which is the transfer price that will determine will enable us to meet up with our target residual income. So I believe you all have the question. Now, based on the question, what is the target residual income? What is the target residual income based on the question? Go to the question, go and determine that. It's clearly given.
That's
180.
80 million.
180 million. 180 million. What is our notional interest? What will be our notional interest? From the question, the notional interest will be what?
12%
Multiplied by
times 3,200,000.
Yes. 12%. Yes. The capital employed is what? 3,200,000, right? 3,200,000. The group cost of capital is what? 12% per annum. So 12% of what? Of capital employed will give you your notional interest. We've established this. That is why I treated divisional performance before coming here. Yeah, before treating all these stories, coming to transfer pricing. So the notional interest will be what? 12% of 3.2 will give you what?
384,000.
384,000. Isn't 1,000 million? Should be million, right?
Yes, sir.
So when you add, you have a result of what? You have your profit to be what?
56400.
564. 564 million. Now, do you have fixed cost in the question?
Yes, sir.
Fixed cost is 1,080,000.
1,080,000. 1,080,000. So your divisional profit plus your fixed cost will give you what?
Contribution.
And the contribution will be what?
1,644,000.
1,644. And do we have variable costs in the question?
Yes, sir.
Per unit, right? Per tire, right?
Yes, sir.
So how will you get the overall now?
Multiplied by
You
unit.
use times the overall production.
Yes, fine. So 22,000 multiplied by 150,000 tires, which is the capacity, will give us what?
3,300,000.
3,300,000. Is this million or billion?
It's billion.
It's billion. Yeah. Let's get used to calling big money.
But we are not seeing.
You will
That
see
is
that.
today. We started calculating it from undergraduate.
Don't worry, you see it. All right. So contribution plus variable cost will give us what?
Revenue.
Will give us our revenue of 4,944,000,000. So in this revenue, we have the value of the external revenue and the internal revenue. Now, based on the question, our external sales in units will be what?
100 and in units.
110, if I'm not mistaken.
Yes, sir.
110.
So how much are we selling externally? The external selling.
35,000.
35,000.
35,000.
So what will be the external revenue now? 35,000 multiplied by 110, isn't it?
So
So that will give us what?
3 billion 850. 3 billion 850.
3,850,000.
million, not billion.
3 billion 850 million.
It's a topic, you know, we're not used to calculating this kind of money. That is why we're finding it difficult to pronounce it.
Oh, this is serious then. All right. Okay. Let's go back to the question. There is something I want to point our attention to now. Now, coming back to the question, for us to determine the transfer price per tire that division A should quote, how many tires is division Y requesting from division S based on requirement A? See,
60,000 tires.
60,000 tires, fine. 60,000 tires, fine. So now, if we are requesting 60,000 tires out of 150,000 tires, what will be left for external sales?
90,000.
90,000.
Fine, 90,000. Based on that requirement, 90,000. So it will be 90,000 tires multiplied by what? 35.
35,000.
Because we're trying to get the internal revenue based on the fact that we are requesting 60,000 tires. So what will be the external revenue?
3,150,000,000.
150.
Billion. 150 million.
So now, the internal revenue will be what? I don't need to tell us anything here. The difference between the overall revenue and the external revenue, right?
Yes, sir.
So what will be the results?
1 billion.
1,794.
794. So now, if we are requesting for 60,000 tires, what will be the price of one tire based on these results?
29,900.
29,900.
So that would be the transfer price for you to hit that targeted residual income. That will be the transfer price. So you divide this by 29 by 60,000 by 60,000 tires. So that will be the internal transfer price. The internal transfer price to meet up with the target residual income. So we have it as 29,900. If you go to your study pack, if you go to your study pack, the solution in at this point is different, but you get same results. There is something they did there. Yes. The computation is you get same results, but they didn't follow it. They cut the process short. Yes. They call the process short. So if you go there, you begin to wonder, what have they done? But what they've done, as we proceed, you have that understanding. Yes, yes, you have that understanding on what the person that computed that they have done. But this is a comprehensive format that will not stress your head on trying to look for one thing or the other. So this is it. Anywhere you go, this is the standard. So based on the question now, let's see what the question is saying. That determine the transfer price per tire that division X should quote in order to meet its residual income target. That transfer price is 29,900, 9 marks, free of charge. So if you go to May 2024, you see another free mark there. Free mark. That once you have this knowledge, you just embrace the mark without any much delay. Yes. So let me ask now. Any question? So that when I bring forth the question, the other question in the Pathfinder, there shouldn't be issue. Just follow this format, you'll get your answer, and you'll be fine.
Hello, sir.
Sir, I just need clarification. No, continue.
Right answer.
Sorry, sir. Please, I had a little network challenge. When you were explaining the external revenue that we got 3,150,000,000.
Yes, sir. This
Yes.
one. So
Hello, Mr. Tokwe.
I'm with you,
Hello,
ma'am.
sir. Okay, yes, sir. Due to network, I was unable to follow the calculation from external revenue. Please, I need a sort of recap from external revenue.
Okay, I think same question with Mr. Nanju.
My own too is close to that one, Mr. Tokwe.
Okay, yeah, now.
You
Say
said,
it.
you said, when we want to give out to the internal, we first of all deduct that of the external sales.
Very well, ma'am.
But you now deducted 60,000 from what we are supposed to supply before you now multiplied by the internal price. That is where I'm a little bit confused, sir.
All right, let's go back to the question. So the question is saying that for A, look at it, ma'am. If division Y provisionally request a quotation for 60,000 tires from division X from the coming year. Now, based on the question, the overall capacity of division X is what? 150. Is 150,000 tires. 150,000 tires. Now, division Y is now requesting 60,000 tires out of 150. Out of 150. So, division X is left with what quantity of tire to give external? 90,000. 90,000. And for you to sell one tire externally, how much is it? It's 35,000.
35.
35. So 35 multiplied by what? By 90,000 tires will give us what?
3,150,000,000. Sir.
Yes, 3,150,000,000. So because we are trying to determine the transfer price that will be suitable for us to meet up with our target residual income, we will now, from the overall revenue, will less the value we are giving out, the revenue we generated externally. The revenue we generated externally. Let's go back there. The revenue we generated externally, which is 3,150,000,000, that is 90 1,000 tires multiplied by 35 naira per tire will give us this external revenue.
Okay, sir.
Give us this external revenue. So your overall revenue, 4 billion 944 million minus 3 billion 150 million will give you your internal revenue that you should generate based on what 60 tires that you will give to division Y, that division S will give to division Y. So, but the question is asking us, what is the price for one tire? How many tires are we giving to division Y? 60,000 tires. 60,000 tires. How much will one cost?
We divide it.
It will cost division.
Okay,
So why are we doing this? We are following this approach because we are looking at the price that will make the organization meet up with the target residual income of 180 million. So once the question is saying target residual income, we apply this format based on transfer pricing. So
Okay,
we'll look at a case whereby the transfer price should be based on opportunity cost. When the transfer price will be based on opportunity cost, we will not follow this approach. Take note. It is when the question is telling you target residual income, you follow this format. Madam Afiniki, I don't know if your question is answered.
Yes, sir.
All right. So, Mr. Nangel and Madam Tolani, hope we are fine.
If I is taken
Yes,
now,
sir.
it's
Good.
clear.
Good.
Thank you, sir.
So let's go to the B part. The B part. That is, the B part is saying that what? Calculate the two prices. Take notes now. Calculate the two prices that division X would have to quote to division Y if it becomes the group's policy to quote transfer prices based on opportunity cost. Based on opportunity cost. I used to like opportunity cost. Yes, because the examiner will always like to test it, but it's not difficult. It's not difficult to determine. Yes, it's not difficult to determine, but the examiner knows that students don't take their time to read some of those literatures very well. So there will now be an issue. There will now be an issue. So let's explain so that everybody in this class will know, will get it. We get it. So determination of the transfer price based on opportunity cost. Still, how many tires are we looking at? 60,000 tires. You can see A, if division Y provisionally requests a quotation for 60,000 tires. You know, sometimes in the exam hall, students don't know how to match questions together. So they will just get confused. You can see this A is having A1, A2. It means this statement is still covering for these two issues. It's still covering for these two issues. So we are still looking at 60,000 tires. If division X is to give division Y 60,000 tires based on opportunity cost, what will happen? Let's come back to this point. Now, the maximum capacity division X is having is what? 150,000 tires. Overall, what they can give out externally is 110,000 tires. The remaining 40,000 tires will be a waste if division Y is not buying it. Will be a waste if division Y is not buying it. So if division Y is not buying it, at what cost should division S give it out to division Y? I explained something like that yesterday at the introductory part. I don't know if most people joined a class that time. So if division Y is not buying it, it will be a waste. So for division X not to lose, at what price do you think division S should give it to division Y? based on opportunity cost.
It will
At
not
what
be at
price?
At the
price.
price they give it at the external price
No.
to the external buyer.
You know, Division X is at the mercy of Division Y now. Division X can beg Division Y, please don't let us lose money. You understand? Because if you don't buy, these 40,000 tires will be a waste. Just help us. So, to cut the long story short, Division S
It will
can
be at
give
the rate of 5,000.
at
Is it
what,
not
ma?
35? I said it's a suggestion anyway. I said 35.
Okay, the same thing Madam Lundi is saying, that at the external selling price. Now, this
The
is the
variable
concept.
cost plus opportunity cost.
Yes, variable cost plus opportunity cost. But what is the opportunity cost in this case now?
The contribution.
Yes, on 40,000 tire, what is the contribution of 40,000 tires? Are you selling it? You are not selling it. Do you understand? There is no buyer for it. It's only Division Y that is interested. So the contribution, there is nothing you are forgoing. That contribution of 35 minus what is that now? The contribution 35 minus the variable cost is what? Let me go and show this. Let me go and show all these stories. Let's show all these stories. So based
Selling price minus 35.
on opportunity cost. Based on opportunity cost. This is it. Based on opportunity cost. There are two prices. You know, the maximum capacity is what? Is 150, right?
150. Yes, sir.
150. The external sales is what?
35.
No, in terms of quantity, 110.
110.
The XX is what?
It's 40.
40.
The excess is 40. This excess of 40, if they are not giving it out to Division Y, it will be a waste. Take note. It will be a waste. It will be a waste. Nobody is buying it. So for them not to lose completely, it should be the opportunity cost will be. Let's show the formula of opportunity cost. Let's show the formula of opportunity cost. Opportunity cost is so opportunity cost is equal to variable costs
Minus
plus contribution in transfer pricing. Take note. Now, in this question, opportunity cost of 40,000 will be what? What is Division Y sacrificing to give 40,000 units to Division Y? What is that thing they are sacrificing? Is there anything they are sacrificing?
No, sir.
Very good. No. So what is the variable cost in the question?
22,000.
The variable cost is 22,000. 22,000. Okay. Sorry. 22,000, right? So what they are sacrificing is the contribution, but the contribution is zero at this point because there's nobody to buy. They are supposed to make a profit of what? 35 minus 22,000 will give you what? 35 minus
13,000.
13,000. You understand? 13,000 should be the contribution. But since nobody is buying here, nobody is buying this 40,000 except division 1. They are not sacrificing this. They are not sacrificing this 13,000. So the opportunity cost will be 22,000. It means what is that cost that can enable them to cover for their production, which is the variable cost. So the variable cost will be the opportunity cost at this point. So division X should give division Y 40,000 tires at 22,000 just to maximize their profits. That is one of the price. Now take note, 60,000 tires is required, right, by division Y. So if we are giving out for 40,000 tires, this is for 40,000 tires. So division Y is still in need of how many tires?
20 tires.
20 tires. Now these 20 tires, the excess here does not cover up for 20 tires. So let me now ask, at what price do you think division Y, division X, will give these 20,000 tires to division Y?
External market price.
Very good.
5,000.
Very good. At the external market price, because this time you don't have option. You have to buy at the price other people are buying. Yes, it will be at the external market price because this 20,000 is factored in this point here. So it will be at the external market price. It will be at the external market price. At the external market price. So division Y will have to buy at the external market price in which every other person is buying. So 40,000 tires based on opportunity cost can be given at the variable cost because opportunity cost is what you are sacrificing. So what will division X sacrifice based on 40,000 tires is nothing. Nobody is buying 40,000. If they don't sell it to division Y, it will be a waste. It will be zero. So for them not to lose everything, the opportunity cost will be 22,000. 22,000. Because they are not selling, there is no contribution. At this point, you can look at the opportunity cost in this way. The opportunity cost, you can look at it in this way. The variable cost is what? 22,000. What is the contribution? 13,000. Isn't it? Contribution is 13,000. So the opportunity cost is what? When you add both, because if they are to sell 20,000 tires, if they are to forgo the profit, they will be losing what? 13,000. They will be sacrificing what? 13,000. They will be sacrificing this 13,000, but getting what? 22,000. So the opportunity cost at this point will be the external market price. So the two prices that they can quote will be 22,000, which is a situation whereby they have spare capacity, 40,000 tires, where nobody is willing to buy. And so they are to sell at what? 22,000 just to cover up for. But in this case, whereby 20,000 tires is required out of the major competitive units that they have to give to the external customers, division Y will have to buy at the external market price, which will be 35,000 naira. 35,000 naira. So those are the two prices that will be quoted. I have a question, especially on opportunity cost. Before the end of the class, I will detect it in addition to, so that this knowledge this knowledge will sync with us, will be with us. So because it is nothing difficult, it's just for you to understand the concept. So I will present another question so that this knowledge of opportunity cost will remain with you and you'll be a teacher to others with regard to this concept. So hope this is clear.
Yes, sir. Hello, sir.
Yes,
So
ma'am.
now, in essence, right? That
Yes.
means in the 40,000 tires, 20,000 tires will go for variable cost, and 20,000 tires will now go for external price, right?
Yes. Yes.
All right. Thank you.
So you see another question again regarding this. I'll forward it or I'll detect it. I don't think I have it typed here. So based on the question, still looking at the question, it's a very long one. So we've tackled these aspects. It's just 2 marks. You can see it's nothing complex, just 2 marks. So B, evaluate the impact of the group's current and proposed policy on the profits of division X and Y. Now, what is the current policy of this organization of Niger's? I would not like to waste much time here. This is just story. The policy, because of the presence of the judging or of the judgment performance of on the single measure of profitability, because when you are trying to measure performance on profitability, on return on investments, on the target-based performance, there can be issue of suboptimality, whereby a divisional manager will try to window dress his account, his profits, so that they can meet up with the expected targets, with the expected target. So the point is, it can affect the overall performance of the business because division Y has other options. You know, the transfer price division based on the residual income target is what, 29,900. But if you look at the question, division Y has option of buying from two other customers. Where are they? Two other customers. And at what price? Yes, from Ades Limited could supply 28,000 per tires, but only for annual orders of 50,000 tires. And Banasa could supply at. So division Y can decide to buy from Ades Limited at 28,000. So Y could purchase tires at 28,000 from Ades Limited instead of 29,900 from company X. And if S cannot sell the 40,000 tires externally, the group's profit will fall. So the group profit will fall. So it can affect the overall performance of the company if they keep on with the existing policy, and if they should go on with the proposed policy, division Y can decide to buy from division X, and it will affect the overall performance of the business. So you can read more on that. For C, because this one is not something complex anyway, but assume that division X and Y are based in different countries and consequently pay taxes at different rates. Division X is paying tax at 55% and division Y is paying tax at 25%. If division X has now quoted a transfer price, take note of this word. Division X has now quoted a transfer price of 30,000 naira per tire for 60,000 tires. You are required to determine whether it is better for the group if division Y purchase 60,000 tires from division X or from Ades Limited. So let's see what to do at this point. So let's see what to do at this point. We're going to present it in a table likewise. We're going to present it in a table. So similar to what we've done yesterday, we'll apply that same concept, that is division, we'll say division Y, buying from division X, buying from division X. So let's take notes. Let's take note of this word. We have division X. We have division Y. Let's say we have the group 2. Let's say we have group. So we want to determine the profits. Is it better for division Y to buy from division X? Or is it better for division Y to buy from ADES? These are the two options we want to look at. So what will be the overall effect on the group's profits? What will be the overall effect on the group profits? That is why we are presenting it in this form. That is why we are presenting it in this form. So now, if division Y, X is buying 60,000 tires, 60,000 tires from X, the external sales of division X will be what? External sales of division X will be what?
3,150,000.
That is 90,000. You know, we are buying division Y is buying 60,000 tires out of 150, right?
Yes, sir.
What is left to division S to sell externally is 60,000, right? 90,000 tires multiplied by what? 35. The result will be what? External sales. I think we've computed that
3,150 million.
Now, what will be the internal sales or transfer sales? Let's say transfer. The transfer sales will be what? 60,000, right?
Yes, sir.
Yes, sir.
Multiplied by what price? Multiplied by what price?
30,000.
35.
30,000. Go and check that question. You see 30,000. Read the question. You see it. I emphasized it while I was reading it. So once you multiply, you do what? You should have what? 1 billion.
1,800 million.
800 million. So the total revenue for division X will be what?
4,950,000.
4,950 million.
You know, some of us will become accountant general very soon in different capacities. So when
Amen.
you are asked to go and defend budgets, don't go and be calling different figures. So anyway, your aides will tell you to rehearse before going there.
Edo governor.
You mention name, you know I'm posting this on YouTube. So they will help you to rehearse. So that now this is the total revenue. Fine. This portion, this 60,000 division Y is buying from X. What are they doing with it? Are they just keeping it?
They will sell it.
They will sell it. Fine. So that will be their own sales. 60,000.
Yeah.
But my question now is, at what price will they sell it?
35,000.
Why?
That's the external market price.
Because they are not adding any value to it again, isn't it? Tire is tire. So
Okay.
it's 35,000 at 35,000. So the value will be what?
2 billion, 2 billion, 2 billion,
Wo-
100
1 million.
million.
All right. Let's move this here. Okay. All right. Let me bring the chairs too. So we have it. So let's take it further. You have the total revenue now. So what will be the variable cost to division X? Variable cost.
Cost of production.
What will be the cost of production?
I think 22,000.
Multiplied by
By
what?
the total tire 150.
Times 22,000. So we now have it as what?
3
3 billion,
billion
300 million.
thousand.
So we now, what else do we need to do? Do we have fixed costs?
Yes, sir.
Yes, sir.
Fixed costs. The value of fixed cost is what?
1,080,000.
It's 1 billion.
Okay, sorry, 1 billion and 80 million. Okay, good.
You see, no easy to pronounce. So.
Well, it's very easy to eat, right?
I'm telling you.
Now, do you think division Y we have a variable cost?
Yes, sir. No,
What?
fixed cost.
No. They did not do further processing.
Yes, so they don't have variable cost.
They didn't have variable cost. The cost of buying it from division S, what will they account it for?
Cost of production.
Yes, the cost of obtaining it from division X to division Y, it will be what? You remember the question you solved yesterday? You know,
Yes,
the
sir.
sales of division A would be what? Would be a variable cost. Would be a cost.
Purchase.
Would be a
Purchasing
cost.
the material.
Do you understand? Yes. So at this point now, we have a variable cost for division Y because they are selling this value. They are selling 60,000 tires to get a revenue. So what is the cost they incurred in getting these 60,000 tires from division X? The cost is what?
1 billion.
1.8.
So if you recall what you've done yesterday, you did something like this, isn't it?
Yes, sir.
We did.
Yes. So that I was emphasizing that yesterday, that take
Okay.
notes. Take
Okay.
notes of such scenarios, that it will definitely show up again. And at that point, students used to juxtapose it. So I don't want you to juxtapose it. That is why I'm emphasizing now. So you see such again. Yes. Even in the question you go and solve, you see such scenario playing out again. Try and overcome it. Yes. I recall the last diet. Student will come back again and ask me, what is this? So this diet, I want you to overcome that challenge.
It will now be the transfer cost, right?
Yes. Yes. And it's a variable cost to them. So
Okay.
the profit will be what? For division X.
Profit.
That is total revenue.
570. That is profit before tax, right?
Very good. Profit before tax. Because there is tax issue.
Yes, sir.
Profit before tax. So for division Y, it will be what?
$300 billion. I don't know.
So now, the question is telling us that we are assuming that division X, they are operating in different countries. The tax rate for division X country is what?
55%.
55%. So for division X, tax at 55% will be what? Tax
Three
on 570 will be what?
313.
313,500,000. Sorry, I can't pronounce it.
You have to learn as an accountant.
313,500,000.
Good.
You know, I'm
Somebody
used to
who,
calling billions.
so division Y is operating in another country, which tax rate is 25%. 25% of 300,000, 300 million will give you what?
75 million.
So your profit after tax will be what? For division X, it will be what?
It will be that's from
For division Y,
Y is
should be
225.
overall, the group profit will be what? When you add the two, you know, they're operating in different countries. Now, there's one thing with transfer pricing. In most organizations, this is a practical issue in most organizations. We have some staffs, some people whose activity is to do this. Yes, I recall while I was tutoring someone last year, though the person is not in this country, but he was giving me more practical view of what he's doing in his own location over there on transfer pricing, how they transfer goods from their own organization to another organization, and he was seeing the practicality of it while we're treating this. So this thing is a more practical thing when you work in organizations that are multinational, and even when you do tax. For those of you that will be doing tax, you'll be seeing more of this in taxation. But you might not do these forms of calculation, but you'll be seeing transfer pricing playing out. Issue of tax playing out in transfer pricing. Yes. So it's a concept that multinational organizations make use of, and it's a very practical thing once you work in some organization that have groups, subsidiaries in various places, and they transfer goods within their division. So it's practical. So what is the group profit now? The group's profit is what?
Sir, please, sir, please, this profit after tax is 225. You remove this 500.
Okay. 225, right? So overall, we have what? The group profit will be what? Profit after tax will be what?
451,500, 451,500,000.
I think this is correct, right?
Yes, sir.
451.
Okay. 451. 481.
481,500.
Sorry,
Okay.
481,500.
Fine. I want to be very sure. So this is division X buying from division Y buying from division X. This will be the effect on the group profit. Let's move to the case of division Y buying from ADES, what will happen to the group profit? If division Y is to buy from ADES, what will be the effect on the group profits? So let's say division Y buying from ADES. So we have division X. We have division X. And let's say we have division Y. Then we have the group. Sorry, excuse me.
Oh God, help us.
All right. So division Y buying from ADES. This is now if division Y is buying from ADES and division Y is not buying from division X, what will be the sales of division X? The sales of division X will be what?
It will be at variable cost.
No, what quantity
No.
will division X sell now externally? What will be the sales?
110,000.
110.
Very good, 110, because division Y is not buying from them. So 110,000 at 35,000. So their sales will be what here?
3,815 million.
Now, division Y. Okay, their variable cost will be what at this point now? The variable cost will be what?
22,000.
The variable cost will be what?
22,000.
Yes, on 110,000.
2,420 million.
You know, the variable cost is changing based on quantity, right?
Yes, sir.
Yes, sir.
So now, for division Y, they are still buying 60,000, isn't it? From ADES. How much is ADES selling one time? ADES, check the question. ADES is selling one tire at what rate?
28,000.
So that will be a variable cost to them. 60,000 multiplied by 28,000. You're going to have what?
1,680 million.
So you have 1,680. Now they are selling this 60,000 tire at what rate? That is their own sales now.
35,000.
And the result will be what?
$2,100,000,000.
Fine. So the fixed cost will now be what? The fixed cost.
Is 1,080,000,000.
Why is it not changing?
It's fixed, sir.
It's fixed.
So, very good, because it's fixed. Will division Y have any fixed costs? No. So now, what will be the profits? The profit for division S should be for division Y should be
350 million.
So now, when you apply your tax rates on the profit, these profits before tax, you apply your tax rates. So tax at 55%. The result here should be what?
192,500,000.
At this point, tax at 25%. You have it as what? 105. Can you confirm, please? And the profit,
157,500.
105.
then for this,
and 315 million, sir.
yes, we're there. Then overall, the group profits will be what?
472,500.
472,500. So what is the question asking us to do now? Let's see what the question. Assume that division X and Y are based in different countries and consequently pay taxes at different rates. Division X at 55% and division Y at 25%. If division X has now quoted a transfer price of 30,000 per tire for 60,000 tires, you are required to determine whether it is better for the group if division Y purchases 60,000 tires from division X or from ADES Limited. So let's now judge now. Let's look at our computation. When division Y obtain goods from X, what is our group profit?
481,500,000.
When they obtain goods from ADES, what is the result?
472,500,000.
What will be your advice now?
Our advice is that they should buy from division Y because they will make higher profits compared to ADEX.
Yeah, so division Y should buy from division X in order to maximize the gross profits, isn't it? So 481,500 is higher than what? 472,500 as analyzed in this class. So you can see how it plays out, how it works out. And there's another question I'll forward to us. And so, but let's take down this
There's a
question.
difference of 9 million.
Yes, which is a very huge amount. It's very significant.
Mm.
So let's take down this question, please, as an assignment. In addition to the question in the Pathfinder, this is to enhance our understanding on opportunity cost. So let me say assignments.
So they say through that your assignment is 5 and 6. And it's true.
I don't used to sleep because of Mr. Topper's assignment.
Yes. If
Already.
you are writing this exam and you are not practicing, you are not ready to pass. Because, and as a tutor, if I'm not engaging you, I'm not helping you. Yes, I have to engage you. Yes, that is my attribute. Because how will I be sleeping and I just teach you and there is no assignment for you? It's not good.
Like you know, I was asking God your network should be bad so that I'm able to sleep.
And
Public
then,
Nobody asked me to go and drink lifting so that I'll be awake because
and the network was, thank God, was very okay today. So I'm very happy.
it was Nanju's prayer.
So if the network was not good, I will not be happy. I don't like that. I've already arranged
Thank God.
myself. So A and B are two divisions in ABC group. In ABC group of companies. The more you solve, the more you get better. And you'll be proud of yourself.
Yeah, it's
Even
true.
when the result is out. So it will give you confidence. Yes. But by the time you don't solve, I just teach you and I allow you to go. I've not helped you. That is it. So by the time we do all this, you definitely go and come across one of the questions or two or three.
I
By
thought
the
you were
time
the
we,
coach, sir.
I'm writing it now. A and B
You
are
are
two
writing
divisions.
it now.
Yes, A and B are two divisions in ABC group of companies. The following details are available in respect of division, in respect of division A. In respect of division A, let's say capacity. The capacity is 10,000 units. 10,000 units. The external selling price. External selling price. External selling price is, let's say, 50 naira. 50 naira. Then let's now say that division B needs 8,000 units. Need 8,000 units. 8,000 units of division A's of division A products. As, let's say, as raw material. As raw material for its final products. For its final products. As raw material for its final products. Transfer price. Transfer price is based on opportunity costs. It's based on opportunity cost. Transfer price is based on opportunity costs. Variable costs. Variable costs per unit of division A is 13 naira. It's 13 naira. So what is the ideal transfer price? What is the ideal transfer price? If external demand for division A is, let's say, 1, let's say A, 10,000 units. External demand is 10,000 units. What will be the ideal transfer price? If external demand is 0 units, if external demand is 6,000 units, external demand is 6,000 units. So what will be the ideal transfer price in this regard? Hope we are all together. Okay, fine. So this is one of the questions. We are expected to solve. Let me quickly search for the other one from the icon Pathfinder so that I can tell you the year. So you can go and you can search for it. Let me see the name. It is. Okay, very good. No, it is. So if I didn't see it here, I will search for it and send it to us on the WhatsApp platform. I'll drop it on the WhatsApp platform. It's very similar to the one we've solved. You apply that same approach. You read and apply that same approach. Yes, as I've seen it. Very good. Yes. So what is the year? November 2021. November 2021. Question 7. November 2021, question 7. Gariki PLC is a holding company with 4 divisions, including Alba and Beta divisions. So the requirements is calculate the transfer price per unit which Alba division should quote to Beta division in order that its budgeted residual income target will be achieved. They are now asking us again, calculate the selling price per unit which Beta division should quote to external markets in order that its budgeted residual income target will be achieved. So you do this approach 2 times. You do for Alba division, you do again for Beta. You repeat same approach. Explain why the transfer price calculated in A may lead to suboptimal decision making from the viewpoint of Gariki PLC. In what circumstance would negotiated transfer price be used instead of market-based transfer price? So it's a very good question to buttress what you've learned in the course of this class. So the question is let me check it again. November 2021, question 7. So please try and solve, make attempts, and we are actually moving towards achieving our goal. The goal is to move to the next stage, and it is achievable when we keep doing this. So thank you very much for your time. We'll meet for financial management tomorrow, God's willing.
Thank you very much, sir.